Hey, and I hope you're doing well today. Today, I wanted to talk a little bit to you about a Ponzi scheme. And a Ponzi scheme is a fraudulent investment where returns to earlier investors are paid from the capital from newer investors. Rather than a legitimate profit-earning operation, this creates an illusion of a profitable enterprise by attracting more and more investors and perpetuating the cycle until the scheme inevitably collapses due to insufficient funds. Now, the origin of a Ponzi scheme originates from a gentleman by the name of Charles Ponzi. He's an Italian swindler operating in the United States during the 20th century. You see, in the 1920s, Ponzi promised investors a 50% return within a few months for what he claimed was an investment in international mail coupons. He used the funds from new investors to pay fake returns to earlier investors, thereby gaining their trust and attracting more and more capital. His scheme eventually collapsed, leading to significant financial losses for his investors. The characteristics of a Ponzi scheme usually inhibit several hallmark characteristics, and I'd like to go over several of these characteristics now. One characteristic is a high return with little to no risk. You see, that's a promise of a substantial return with minimal risk, and that's a common lure. Legitimate investments usually carry some degree of risk, and higher returns often entail a higher risk. A second characteristic is an overly consistent return. Investments generally experience a fluctuation over time, a high and low. A scheme that consistently generates positive returns, regardless of market conditions, should raise a suspicion. Unregistered investments. You see, Ponzi schemes often involve investments that are not registered with financial regulators, depriving investors of access to critical information about the investment. Another is unlicensed sellers. These are operators that are unlicensed or are unregistered in order to circumvent regulatory oversight. Another characteristic is secretive or very complex strategies. You see, the investment strategy may be described as too complex to explain or kept confidential to avoid scrutiny. Another characteristic of a Ponzi scheme is issues with paperwork, such as errors in account statements or difficulties in withdrawing funds, so they can essentially indicate fraudulent activity. Now that we know what a Ponzi scheme is and sort of what to look for the characteristics, we should look at the tax implications for the victims. You see, victims of Ponzi schemes may be eligible for tax relief under very specific provisions, such as theft loss provisions. You see, the Internal Revenue Service allows victims to deduct losses from Ponzi schemes as theft losses instead of capital losses. This distinction is very beneficial because theft losses are not subject to the $3,000 annual limit that applies to capital loss deductions. And there's a safe harbor provision that the IRS has established in 2009. You see, it enabled qualified investors to deduct a specified percentage of their investment loss in the year the fraud is discovered, without the need to prove the amount of the loss or the intent of the perpetrator. This simplifies the process for the victims seeking the deductions. Now, in order to claim this theft loss deduction, victims must complete a very specific form and attach it to their tax return. You should have as many detailed records on the investment, communications, and any recovery that you've attempted to do. You should absolutely keep these in order to substantiate all or any of the deduction. Something else you may want to consider is any potential or actual recovery from the perpetrator. Insurance or other sources will reduce the amount of the theft loss. And it's essential to at least consider these when calculating the deductible amount. Now, if the theft loss deduction results in a net operating loss, that could be carried backward or forward depending on the laws at the time. This could potentially result in refunds for prior years or a reduced tax liability in future years. And in order to see if you qualify, make sure you talk to your professional advisor. That way they can help you navigate these provisions effectively. Experiencing a Ponzi scheme is, not only difficult financially, but it also has extreme emotional repercussions as well. There's no reason why you should feel any type of way about being lied to in regards to these investments. See, the IRS provides avenues for tax relief, and the goal is to mitigate some of the financial impact. You're a victim, and it's crucial for you to maintain thorough documentation and consider making sure that you do this through a professional and make sure that the compliance with IRS regulations are maximized. Dealing with a Ponzi scheme is difficult. Don't go it alone. Don't be afraid or scared or embarrassed about having to deal with a Ponzi scheme or having someone lie to you. It's not your fault. Remember, you're the victim. If you were a victim of a Ponzi scheme, please contact us. We're more than happy to help you. Make sure that you file the tax returns the right way. And if you have any questions about this, please feel free to reach out.